All right, and we are live. Take it away, Roy, while I pull this up.
Bootleg Weekly, guys. Yeah, it's at an unusual time, a little bit early, better early than late. Tonight, we're going to, or not tonight, I guess this afternoon, we'll be looking at the market, of course, as it closed, a couple of movers and shakers. And for sure, we'll want to discuss if China is investable and some Tesla as we enter close to the 10/10 event here in a couple of days. Tevis, how you doing?
I'm doing good. I love putting you in those situations as soon as we go live. But you're handling it better and better every week, man.
It's better than just saying,
But I'm just tweeting this out, so give me a sec.
Oh, yeah. And let me pull up some charts here. I know a couple of folks like charts. Actually, one of the interesting, you remember when I told you back in the little yen carry trade crash, Hood was trading about $14, and I'm like, you should buy some. Do you know what Hood closed at today?
Oh yeah, I saw your tweet. That's the only way, that's the only reason I know what Hood closed at today. Hold on, let me pull up my Weibo and we can walk through some of these names live.
It was a pretty green day. Not for every trade, but like the week is strong. Like Palantir, of course, setting new 52-week highs. Actually, had a lot of names, new 52-week highs. We, believe it or not, are in a bull market. Now, one of the things to keep in mind is there's always bears that are like, well, yeah, but what about this? What about the election? What about the national debt? This is a normal thing for bull markets.
What am I looking at?
Hood? Yeah, bring it up. Hood.
$25.
25.61. Yep. Now
Roy told me to buy right down here.
I did. I was like $14. That's a no-brainer. And I think by the time you looked at it, it's like 15 and some change. And like, you should still buy it. And you're like, nah, I'm good. You might have bought it. Like if you
right here is where Roy told me to buy it. About 69% ago.
I tried.
Some people just don't deserve to be rich, and I unfortunately am one of them. So I like staying poor. It suits me.
You'll get there the good old, honest, hardworking way. And then index fund investing. Nothing wrong with that. Man, it has been quite a year. So Hood was one of those. I don't know that we've talked too much about Hood on this channel, but it's one that I targeted at the end of December. I talked about a golden confluence, basically three big catalysts on all their platforms. So between interest rates, between crypto, and between a bull market. All those played out. Crypto's not doing quite as well as I expected. And so my thesis was at the end of December when it was trading maybe $9-10, I said, I think the base case for Robinhood this year is $26 by the end of the year. Think we get to $26, Tevis?
Oh, yeah. New 52-week high today, apparently, too.
Yeah. It just – and so this is running it's running partly because everything's running, right? But I think that there's two pieces of interest. One is next week, and I'll be at the conference that Robinhood has when they're rolling out some new trading features. It's actually a 3-day conference. Seems like it's a bigger deal to Vlad and co. than the Robinhood Gold event. They're, I think, fundamentally undervalued even here. When they report their quarter 3 earnings, I just don't see any way that they don't show a 40% year-over-year growth again. And so their price to earnings is like 30 something. It's not crazy for price to earnings at all. For a 40% growth rate, it's actually pretty cheap. But I think that the big catalyst here is, and it was announced a day and a half ago, that they actually have an investor day, their first investor day ever, and that'll be in December. So the struggle for me with Robinhood is when I was entering this trade back in December, it looked very, very cyclical, and I was right on that so far. But the long-term thesis, I'm like, yeah, it's there, but maybe I can catch that next cycle. Now, with the products that they've rolled out this year, the level of execution, and who knows what they're coming out on the investor day, but that's like the long-term vision of what democratizing finance actually means to Vlad. I may be convinced to become a long-term shareholder. We'll see. I'm like most of the way there, but still, if you had pressed me today, I'd be like, okay, I'm out by January. So,
bro, we all know what's going to happen. Okay. We know what's going to happen. You're going to go to the Robinhood event. You're going to meet Vlad. You're going to shake his hand. You're going to ask him some softball questions. And immediately you're going to come out being like, I'm a full-time all in Robinhood investor now. It's going to happen to you. It's going to happen to Tanner. And I mean, I don't blame you guys necessarily. They have a great product and they're innovating in pretty nice way. Like as a product guy, I can't be negative on them just with the stuff that's rolling out, the user experience that they have, and just the satisfaction that they have across their user base. It's something that, in my mind, doesn't seem very hard to replicate. But the fact that en masse others haven't replicated it, I think speaks more to them than it does to Robinhood, right? They're clearly doing something right, and their numbers are reflective of that. We don't have them in Canada, but I mean, we don't have a lot of things up here. So
yeah, and good riddance. I mean, not just kidding, but Robinhood, their long-term thesis is stronger than it was a year ago. They, I think, have made themselves through the subscription revenue. I think credit card business as well might be one of those, and then retirement assets, really a lot less cyclical than they were before. One of those concerns that wasn't there before, though, was how well are they handling the credit cards? We don't know that yet. And the nice thing about this trade that I'm in, if it is just a trade, is there's really no risk with credit cards until next year. Next year, it could pull a SoFi and just be an unmitigated disaster, actually even more so because of the way that they've scaled this product. Like Anthony Noto was, throwing shade at Robinhood, and he's right, frankly. Like there is some risk. I'm Beneficial noted, and he said, "Hey, what are you waiting for? $30 to buy?" If I'm convinced that Robinhood is a long-term trade, I'm fine buying it at 30. But probably more realistically, what I'll do is convert some of those $15 leaps into shares. And now is that a great entry in Robinhood? It's fine, but like I've made a lot of money off of selling the leaps, so I'm going to be okay. But we'll have to see. Yeah, we're taking Ahmed's market share. He's in India. This is our time now. So no, realistically. So one thing that's happening, guys, you want to tell these guys about the show that is coming out tonight?
Yes. So there is a show coming out tonight. Small show. You might have heard of it from time to time for us talking about this stuff. It's called Hims Weekly. It's going to be the first episode, and hopefully, if we can keep it going, a long-standing, permanent, recurring show. We're going to get some content creators that have been making content way longer than myself or Roy about Hims to share some stuff. These are the people who I always reference when I'm making my own videos, and I think it's going to be a lot of fun. That is going to be at 6 p.m. Eastern on this channel. Probably we're going to be done Btlg at 5. You have a chance to take a break, grab some dinner or whatever, and then come right back here for Hims Weekly at 6 p.m. And you get to meet all the fun new people that we've wrangled up from this community. And the hope here is that we can build this up to be something hopefully similar to what we have for SoFi Weekly. We have a really great community there, consistent people watching on a weekly basis. My name is not Travis, go fuck yourself. But other than that, yeah, come join Hims Weekly at 6 p.m. on this channel.
And yeah, I'll be the novice as far as it relates to him. There's a lot that I don't know. I was even corrected on something today. I said semaglutide, which is their GLP-1 product, was oral. It's not. Like instead, their oral weight loss solution is a compound of several different medicines. So yeah, this is Hims. Like it just shows you, and we won't talk about it very much today, but like it just shows you how volatile this thing is. Got down to 1626 on some news, went all the way up to 1973 today. On a very strong market day, it's down on basically headlines that don't relate to Hims at all. So it's as if, like, if you're a Tesla investor, it's like that Ford has some headline that relates only to like their F-250 product, and then Tesla dumps 5%. It's like, oh, well, that's weird. That's kind of what happens with Hims all the time. It's so volatile. And you can see that all the way through the year, although it's had quite the run. Year to date, it is up almost 100%. yet. I didn't do a buy this week because I did 2 buys last week because we had that really nice dip down to 1365 back in September 6th. That wasn't it though, but it went down to 1713. Actually, a little bit lower, 16 something in the 24-hour market, by the way, which is another amazing thing about Robinhood. If you're on there, you have access to the 24-hour markets. So when these things are dipping, just on low volatility and news, they tend to be accelerated even more so. You can get in at cheaper prices there. You can be in like the China trade and be doing a lot of that. I saw last night, I think 700,000, maybe 800,000 shares traded on Alibaba alone on Robinhood's 24-hour market. And that's just one of many names. So you want to talk about China?
Yeah, we can. I'm trying to post something on Twitter, and it's saying that Twitter's blocking it because it thinks it's spam. And I'm like, I'm a real human here, guys. But okay, I will figure that out. We can definitely talk about China. Take it away.
So this is one that's been all the rage. You can see kind of, I'm not sure on the date, of September 19th or 20th, right around there. Actually, might have been Monday as well. China announced the news that they were basically pumping their market full of stimulus. It's kind of like, but not as extreme as during COVID when our Federal Reserve did the same thing. And so they artificially lowered rates on mortgages and just, in a communist nation, a dictatorship, essentially, you can just say, this is what you're doing, period. And it's like, rule of law doesn't matter. And so as a result of that, a lot of these assets, which are heavily shorted, some of them, ended up being going on quite the run. Now, today, Alibaba, JD.com, Pinduoduo, which is Temu, and many others, Lee, are down by 6, 7, 8%. But it doesn't take away, like even in the last 5 days are down. But over the last month, Alibaba is probably the most prominent of these. It's up 34.68%. You look at their valuation, their price to free cash flow, their buybacks. It looks on paper like, wow, this is a great opportunity. Why wasn't I an idiot? Why wasn't I in this? Travis, are you in any plays like this that are China plays?
Great question, Ron. I'm actually not in any China plays. I was in China plays back when I started investing in 2017, 2018, all the way until 2019. And I have gotten burned by China plays in the past. So I am no longer in China plays. Yeah, it's as simple as that. And I think like I've shared my thought process on why I'm not. And it's the same thesis as many people have. The same reservations with regards to China is that you have this government that, en masse can crank up or down the market with their broad sweeping sort of hand. And yes, we are having great performance on China in the short term, but then you zoom out over the past decade and it's like levels where it was back in 2007 essentially, and hasn't really moved from there. So it's just, in order for me to be in China plays, me personally, I need to have an inherent trust in that government to control the market as like a free market, to let it do what it will. And that's just not the case, is what we see, right? Like you can be invested in Alibaba or any of these other companies, and then all of a sudden Jack Ma goes missing for 3 months and you're like, oh, wait a minute. This doesn't really sound like a great, like think of it, if Tesla was a Chinese company, Elon Musk would have gone missing like forever now. Yes. What does that do to my investment? And so that risk is always in the back of your mind is, well, how outspoken can these people be? But then the other side of it is that if you have a relationship with if you're invested in a company and that company is cozied up to the government, then that company will receive benefits. I think this was the case for NIO, where the government took like a 50% stake in NIO or something like that. I don't remember all the details. And they essentially became partners, and NIO went from like $1 to $20. So you can definitely find plays, but I think on a risk adjusted basis, you should really take it with a spoonful of salt, because just as that trade can go your side, it can go against you in a hurry, and you don't really have visibility, with regards to that at all. And that's just the thing that, like, I could go into a China play with a very small, percentage of my portfolio, super, super small, and treat it like a call option. I do mean spoonful of salt. I know grain of salt is the expression, but I mean many, many grains of salts. But sorry, that like threw me off. I lost my train of thought. But my point is like, I would never go into China with a large chunk of my portfolio, because that risk always is going to exist regardless.
Yeah. So to take one step back, some folks mentioned that all these companies dumped today, and it was largely because there was a announcement from the government, and they talked about their stimulus, and it basically wasn't what the market was hoping for. It's a little bit less aggressive or accelerated than many were thinking. But I think regardless, it probably is going to be a sell the news event anyway, just because, I mean, when stocks rise up 30 something percent in like 2 weeks, not even 2 weeks. Yeah, there's people that want to get out. They want to take profits. Hello, Toto. We do see you, by the way. One other risk with China too is you don't have direct ownership of your shares. We as Westerners, even in Canada, are not legally allowed to own shares in Chinese companies. That's Chinese law. Maybe that'll change one day or not, but in some overseas companies, you don't directly own, but there's a holding company. Here, you have a holding company for a holding company in Hong Kong for the shares. And so there's a couple of layers of failure. And it just takes one event, just, if their king, basically their emperor, has a bad day and is angry, he can just say, you know what? No more of this. You're done. I don't think they'll do that. I think the only event that they would actually do that in is to either cause us some political trouble, or more likely, like in the event of a Taiwanese war, if we between China and Taiwan, if we intervened, and if so, all bets are off. Of course, that's going to hurt the American markets no matter what. But yeah, I mean, like when you are investing in a company that doesn't have and doesn't appreciate the rule of law, there's some risk, and it doesn't mean that you can't make money here. Like, obviously, people that have been investing and holding for a while, they're probably still down, but if they've been averaging down, they may be up. Great. That's awesome. But there's a risk of it literally going to zero overnight just because of that lack of direct ownership, or going down big time if they decide, hey, we're going to shut down the country. They've done that a number of times. Or we're just going to issue a common prosperity tax, which they did on Alibaba and several other big names. Or they say, hey, you can't be listed in Western markets, which they've done before as well. And it's just thing after thing with China under their current administration and leadership. So I'll take one more step back. I don't invest in companies where I don't trust management. It has to be good, if not excellent management and leadership for me to invest. I've been burned before because I'm like, hey, this is a great valuation, great opportunity. What they're doing is awesome. And that management underperforms. Here, the management, do you know who the management of Alibaba is, Tevis?
President Xi, I don't know.
Yes, President Xi, the CCP. That's the way it works in a communist nation. It's not whoever appears at the CEO. I know it's not Jack Ma anymore, but there's somebody else there. But he is directly under the CCP and under Xi. And so if he ends up just saying, hey, we're going to do some changes and things on Alibaba, they can't appeal, they can't petition. It's just, you're not protected there. And so there's that extreme danger, which we've seen, especially in Alibaba. So myself, I will not touch China at all. I do see, like, you could trade and you can make money. That's fine if you're doing that. Still be careful. Myself, I look and I see there's still a lot of opportunities in American companies. And I do have one foreign company, that's Nubank. There is some geopolitical risk there because Brazil is kind of a mess right now, to be honest. So, but it's really spanning out towards all of Latin America eventually. It's very much in Mexico. Not a perfect situation, but that's one of the reasons why I'm heavily, heavily, heavily concentrated in the good old US of A.
I have a friend who put a good chunk of his portfolio in Alibaba, but I think he did it in like 2020 or 2021 at like $200 a share. I think he's been averaging down, but it's just my reminder when you put up the chart for me to reach out and say hi and ask him how he's doing with that position. But yeah, I feel the same way about China. Like, I feel the same way about all international companies as I do about China. But China is very far on that spectrum for me. Like, I believe the US capital markets are where the majority of capital around the world flocks to because of the soft power that the US holds for, like, it's so embedded in their principles, this idea of capitalism and consumption, and as a result, economic growth through these companies, that if I was in Eastern Europe, or if I was in Africa, or if I was in Asia, like, I would look to invest in US companies. They're the most prominent, they're the biggest in the world. Now, I understand that that's flawed logic, because you can find a lot of opportunities internationally, especially as you get this like power dynamic shift. But at the same time, I think that I'm going to, put my money in the vast majority, predominantly in US markets. And I say that as somebody living in Canada who gets tax breaks for investing in Canadian companies, and I don't, because they just don't perform at the same level, from a returns perspective. Like, why would I care about getting a tax break on a company that does 10% CAGR when I can just pay taxes on a company that does 40% CAGR? Like, it's ridiculous. So I get it. In the case of New, like, it's growing very fast, but in the case of all these Chinese companies, again, that unknown factor with regards to the government is keeping me away.
You okay? So if you don't mind throwing up Bayre's question,
Yeah, okay.
I'll answer that. So I think most of you guys know, but I like selling options. I do that all the time. There is some risk even in selling options. I think it's less risky once you know what you're doing. So I am selling covered calls and some cash secured puts as well. Pretty much all of my positions, I actually misspoke. So I'm not doing it in Tesla right now, just because the October event, it doesn't make sense for me to do that. I would actually be selling cash secured puts if I wanted to be assigned, but I have that in other opportunities, and I've been trying to invest my cash more and more in the market. So I don't really want to have, what is it, $25,000 in cash lying around. Like, I'm comfortable with like 10,000, 15,000. That's fine. But and I'm also not doing any covered calls in SoFi right now. The reason for that is I don't sell covered calls except with rare exception in plays that I view as very undervalued, because I don't want to be run into a price where it goes into the money and then I'm forced to either roll and take a loss or get out of that position. I only set it for levels that I'm okay exiting and or possibly rolling, even if I think it's very unlikely to be there. And so, and the other phenomenon is SoFi has a lot of short interest, and so there are catalysts that can happen with SoFi. And we've seen a lot of price action movement on SoFi. Like earlier today, it went up, I think, close to 5%, fell down to 2 something percent. But it can move up 10, 15% in a given day. Is that likely? I don't know. I think at some point over the next year it will be. But I'm being careful on that one. So the rest of my plays, he mentioned, look at his next tweet. He mentioned Robinhood and Palantir, I believe, as well. If you could throw that up. So the way I approach Palantir is I do not want to be in a position where I have to sell my shares. So I ended up selling a 44 strike on Palantir. Now, could that go on the money? Well, let's pull up a chart.
Yeah, let's definitely pull up a chart and make this Palantir stream again.
Yes. Well, it's kind of an illustration of where I'm at with. So I tend to sell my
Yes, it is.
His brother. I tend to sell my covered calls with a between a 90 and or 0.9 and 0.95 delta, which basically means there's a fairly low probability of these running into the money. So Palantir this week, let's see, it started out on Monday, opened up 30, just under $40. I sold for 10% out, so that was $44 strike. Had okay premium, like I'm actually underwater, but I thought it was very unlikely that it would go to 44. and I'm actually okay at 40 for exiting my leaps, which I'd prefer to wait for 45. I don't think that I'll exercise those. I don't have very many of those. All my stocks, I would just roll. So like if this hypothetically runs to like 40, 45, 45 by the end of the week, I think that's pretty unlikely. I think that's actually really, really unlikely. It can happen though. This is Tuesday. We got 3 days left. Maybe there's some big catalyst that comes out. Then I would absolutely roll. And I would sell my leaves.
I think,
now,
yeah, go ahead. Sorry, finish your thought.
Now, Robinhood, the way that it's working is, it's up big, but I actually sold for 25 strikes. So I think Bay Ray and I are at the same place. Not on all of so I'm doing poor man covered calls. The difference is I don't own any underlying stock. It makes it a little bit trickier to exit because you needed some liquidity to cover some of those covered calls if you did want to exit that position, or you have to have a liquidity to buy the stock. Otherwise, you get margin called. So know what you're doing before you do poor man covered calls. Please, please, please paper trade them and study up on them. They're a little bit more tricky than just simple covered calls. But in this instance, I think I don't remember how many shares. It's maybe like 40% of my remaining only options that I plan to exit in January anyway. And so if this price holds, that we're at 25 or above, I'll actually exit those. It's 40% of my remaining position. And the rest I have not sold poor man's covered calls on. And the reason for that is all of the rest are in my tax advantage accounts. So I can't do poor man's covered calls, at least in Robinhood. So, but those I'll just keep. I'll continue to let ride. But this is kind of a unique situation. It's my only position where I'm 100% in options. Usually I'm like 85 to 90% stock, and then I have a chunk of options. Robinhood is that one that I just entered with a whole bunch of leaps and printed a lot of money. So keep going, Robinhood. Then I'll add one last thing. The nice thing about the poor man's covered calls is, so this went up $3.17 per day, or today rather. And so on the $15 strike leaps, which I've sold the poor man's covered calls against, that means that they went up like $270 or so per contract. And then those the $25 strike covered calls that I sold, yeah, they're underwater, but those went up like $90 today. So if this keeps running, great. I make even more money up to a certain point, right? So this does limit my upside. That is the risk of poor man's covered calls.
Sorry, what are poor man's covered calls? They're just when you buy deep in the money, or what?
Yeah, no. So poor man's covered calls is I don't own any. I don't own 100 lots of this stock, but I do own options contracts. In my case, and it's usually better if you're going to sell these to buy deep. If you're intending to do it for this reason, you buy deep in the money covered calls. So like I would be buying now, and I didn't do it this way, but I would be buying like $15 strike Robinhood because they're deep in the money. You have a high delta, and so it's kind of like it's a strange form of margin. But I can't sell regular covered calls because I don't have the stock. So if Friday hits, they're looking for the 100 shares, I don't have it. So poor man's covered calls is, instead of having that, my collateral is these options contracts that I have. Now, technically, you can still do that with out of the money contracts. It's just there's a lot of danger there because you'd be on the other side. So like today, my leaps that I own went up close to $300, and the covered calls that I sold went up $90. So I still made out like a bandit. Versus if I had like $40 leaps on Robinhood, I think they go out that far, they would have went up like maybe $40. And so this would really be dangerous for me. So yeah, poor man's covered call is just, I own the leaps. I don't own the stock, and they will use that as collateral.
So you're using your leaps as collateral to write covered calls?
Yes. Yeah.
Got it. Interesting.
Yeah. If you ever get into options, be a little careful with that one. Just make sure you know what you're doing. This one, until this year, I was not prepared to do poor man's covered calls.
So it's interesting, right? Because I had a few guests, over the past week, and went on vacation with them, and many of those guys do options on a regular basis, and I ended up calling my broker and checking. I think I told this story at SoFi Weekly, but or maybe it was the after hours. But long story short, my broker will have the ability for level 1 in the next week or so. So your boy is going to be able to write covered calls and sell puts and do all that fun stuff. And yeah, I've had just these long-standing positions that I've built up over years that are not making me any money right now, but they're just like, it's just large chunks of money that's locked up into certain things. And so I think I'm just going to start off with some Tesla covered calls, and then just do it with half my Tesla position, and then eventually, as I learn more about it, scale up. I don't think I'm going to do it with SoFi just yet because it doesn't, like, quite frankly, it doesn't have the premiums there to make it worth my while. But yeah, so I'm going to be learning more and more about them, and I'm sure we're going to have TJ on the stream more often, and just trying to form an idea of, like, okay, if it's 1 week out, how much, like 20% above what it's trading at, 2 weeks out, 35% what it's trading at, and so on and so forth, so that I can form an idea of, like, hey, what is my likelihood of actually not having to roll? And then I got to learn about rolling in general too. So it's going to be an exciting time because this year I didn't really have the ability. Up until now, I haven't had the ability to do covered calls. I didn't even know what covered calls were, 2 years ago. And so this year was the dividend portfolio, and that's been treating me very well because I don't have to do anything for it. But I think next year I'm going to concentrate more into like 3 or 4 positions in that dividend portfolio and just build, like, just make it all around covered calls into positions that I want to be holding, like, long term, but also positions that I really don't care if they get called away. Like, if they get called away, I can just buy at a certain price through puts again, and I'm not really fussed. So I kind of want to do, like, maybe Tesla, Meta, QQQ, Amazon as, like, 100 shares of each, and then seeing how much that juices out per year versus having a portfolio in dividend paying stocks. It's going to be a little bit more active effort, but I think it's also going to be just more fun and more educational as a whole, because I get to learn about these concepts. And we were talking about all kinds of stuff that these guys were doing, and it was just really interesting because, like, I understand basic concepts. It's like you understand arithmetic, and now you're going from arithmetic to, like, algebra. We're like, oh, well, you can do this one merged with this other one, and then this is fine, and this is what your liquidity becomes. And I'm like, okay, well, like, let me say that again. Like, yeah, that kind of makes sense. Okay, I'm starting to get it. But once you put it into practice, you're just going to get it more and more. So that's my goal, I think, once my broker starts allowing it.
Yeah, spreads like at level 3 and level 4 options, those are tricky too. And I don't do those often either. I'm a plain simple guy. Bay Ray did ask a pretty good question, though. What happens if the expiry above your covered call on a poor man's covered call? Do you sell the leaps? Do you get the gains from the leaps? Usually, you don't want your contracts to go to expiry, especially in the poor man's covered calls. So in this case, because I don't have the collateral and I don't have whatever ungodly amount of cash that would be to buy the shares, then I would be margin called. And I don't want to be margin called because then they start selling things for you. And sometimes, and I don't know how it works with Robinhood, there's some grace. Maybe TJ knows.
You say covered calls 3 times very quickly, and TJ just pops up in the chat. I love it.
Yeah. But what I plan to do is at least 15 minutes before the end of the day on Friday, let's say we're at 25.61 still in Robinhood, that it stays there all the way through. I will then completely exit that 40 or so % of my Robinhood position. So I'll start by buying back, and it will cost me money, and I have the money for that. The covered calls that I lost on, and then I will sell the leaps. And so that's just the way that I'll do it. Otherwise, if I didn't do that, margin call would happen on Monday. They may automatically sell stuff for me. I've never been through that. And in fact, I've only had to roll stocks twice ever. That's in almost 2 years. Well, actually over 2 years, but I've really only heavily been doing selling options since the beginning of 2023. I dabbled in 2022, and I had no idea what I was doing in 2021. So made some mistakes, but they were very, very small dollar amounts. And it's like, oh, theta is a thing. Yes, it is. Everybody, like, they experience that once, and they're like, but the stock went up. I should be making money. It's like, no, you got to know the Greeks, understand the Greeks. I'm not an options expert, so I don't talk about it too much as far as like specifics, just because I don't want people not knowing what they're doing, trying to follow or figure things out. But yeah, that's just kind of how I see it. It's just some extra premium. This year has been very good. It looks like I'll be between 10 and 15% yield on all my portfolio off of this options strategy. So I like that. And of course, I'm up actually a little bit over 100% on my main portfolio.
So we were talking about it, and maybe like as I get more into this, like I'm going to bring more people on here that I can actually like. It becomes more personal once you're actually doing it. It's not just theoretical anymore. But we were talking, the same group of friends and I, like in person, around what is the sweet spot of what percentage the premium should be. So they were saying like, okay, one of your covered calls, because they'll do monthlies or they'll do like biweekly. And they were saying that, one of them was getting like 2% and the other one was like, oh no, it should be closer to 1%. Like, is there a sweet spot around the total relative to the cap? Let's say you're putting 10 grand to buy covered or to write covered calls against. What is the premium relation there? Because that's obviously going to affect how much risk you're taking. If it's 10%, then you're probably taking on too much risk.
So that's probably a better question for TJ, because I think his main objective in the way that he makes money is, CJ will know, right, Travis? But
that's right, Ron.
I think CJ, I know TJ, I think his main strategy is to make money off of wheeling. And so what happens is, for me, it's just a cherry on top. I don't worry too much about like the yield. And so if I think it's a mistake for most people. So you do dividends, right? So one of the things that happens, and I apologize, the phone is ringing off the hook. I muted it. Yay. In my office, guys, that's just kind of the way we need to do it today. So with dividends, one of the mistakes that dividend investors make, and I think most people understand dividends, is just focusing on the yield, saying, yeah, exactly. We want your Robinhood collateral now. Not really. That can happen actually early. It absolutely can. That's one of the crazy things with options, by the way. It almost never happens when people exercise early, unless it's really far in the money, but it could. But yeah, that's not what's happening. So with dividends, when you're looking at dividend companies, if the only thing you look at is the yield, right, then that's probably, and you're like, wow, this is a 20% dividend in the year. There's risk. That's probably like the TSLY, like the yield Tesla one, the yield max. I'll show you this TSLY.
Yeah, I think my buddy does TSLL, which is the 2x leverage.
That's fine. And it makes sense. It's kind of like being in options. This one, it's a yield max. And so like year to date, we know what Tesla has done. Tesla is up more than 40, negative almost 50%. And all they're doing is basically doing the will strategy for you, giving you monthly dividends that are very attractive. I don't know what it doesn't have the yield there. I'm sure on Yahoo it would. But they give really strong dividends, but you will almost always underperform the actual equity. And so that's just not worth doing. Now, so you're invested in a terrible company just because of the yield or a terrible strategy. Instead, what's better to do is, if you like dividends, go into a dividend company that you really like, and maybe it gives a 3% yield or 4% yield. That's great. That's a cherry on top. And that's the way I approach selling covered calls is for most of my companies, with some exceptions, I have certain levels where I will exit a part of my position. And so I'll be a little more aggressive there. But I will, and that's what I'm doing with Robinhood right now, because I got till the end of the year. So even though I think it's still undervalued and it'll run, that's just where I'm at. So I don't chase the yield. I just say, okay, what's basically free money that's on the table based on the delta, based on what I know about the company, based on what I know what the catalysts are. And I have a very limited knowledge of TA, but TA does come into play. And this is really only one of two places where it comes into play for me. And I say, okay, what looks like free money? And then I'll go even a little bit further out of that. I make a lot less than, probably anybody else that's selling this strategy. But it's like today, like one of those free money things. I think I was looking at Palantir at a $53 strike, and I think it was selling for $1 per contract. Now that's nothing, but like, is Palantir going to get to $53 in the next 4 days? It will not. No, and that might have been next week. And so that's like, that's free money. It's like, why not take that? And there's some risk, but it's so unlikely, dude. Like, it's not going to run to 53 in that little bit of time.
Well, yeah. So that's the thing that I like. Like, it's all probabilities. And for me, I mean, we're going to have an episode just dedicated to this stuff. Like, once I actually unlock options. And I think that in the start of the new, like, I want to see how this strategy works out for the dividend portfolio until the end of the year. And then I think at the end of the year, I'm probably just going to like sell everything except for like 3 or 4 positions and just build those positions and try a new strategy over 2025 and see what works. At which point we're going to have, we'll have more people on just to have a more, dynamic conversation about some of the nitty gritty stuff. For me, like how I'm leaning towards it right now is go more risk averse and never really roll to the point where, like, okay, let's say Tesla's at 250. What if you put 320 there for 2 weeks? Could it happen? Sure. Likelihood very low. You're probably going to juice very low premiums out of it. But even if it does hit, like, cool, I'll sell at 320 or 325, whatever it is. And that's fine. Like, I don't understand why I would ever roll in a situation like that when I can just buy those shares back, maybe just, through puts. I can choose what price I want to buy those shares at. And if it never hits that price, then I can still collect that premium. And if I want to buy Tesla back at, let's say, 300 or 285 when it pulls back, okay, great. I, fuck up my cost basis because it was a nice, pretty number, which is not anymore. But who cares? You've still capitalized and you've gotten paid throughout it, and you're still going to hold Tesla long term. Like, I haven't yet discovered what the flaw is in that logic. I'm sure there is a flaw. Like, there is a reason why, TJ and yourself and other people roll. Mm-hmm. But to me, it just seems like it's all gravy if you think the company's going to go up and to the right over the long term.
Yeah, TJ hit the nail on the head. Is if you're not in a tax advantage account. So like my Palantir is up. My average is in the 12s. My net average, because of selling covered calls, is actually about to go in the 6s. I think one more week and it's there, depending on what that yield is. So if I sold, like, it's long term, that's great, but there's going to be a big tax bill, and I want to hold this company long term. Now, the other thing too is sometimes companies don't go back. So people that sold covered calls more aggressively, like Palantir at like 14 or 15 bucks when it was trading at 11, they got smashed, and it never went back. And I think at some point it's certainly going to pull back, especially up here, but I could be wrong. And so, long term, it's a lot less painful, but I don't want to sell out of that position. And so the 2 times that I've had to roll were both on Palantir. It was not a very costly roll. I think it was maybe 16 bucks per contract one time, and I made that back within 2 weeks, selling covered calls. But there's also times on positions where, like, for instance, when when Palantir was entering the S&P 500. That wasn't guaranteed. I didn't even think it would happen this quarter. I thought it happened next quarter. And a lot of people still sold covered calls very aggressively. And of course, it ran up. It went from 24, 25, and now it's trading in the 30s, now 40s, actually. There was no way, no measure of safety at that point. Like, it just was off to the races. And there's catalysts with certain companies that aren't even expected. But that one is like, you know what? I'm not going to sell covered calls this week, even though it's on Friday and I could exit it early, just out of concern for this happening. I didn't want to touch it at all, just in case someone leaked something. It just wasn't worth it. I've also sat out sometimes, even though it's a lot more lucrative, as you'll find, just because the IV is up a lot higher during earnings season, which we're about to enter. There are some times with some companies, and SoFi is one of those, that I will not do any kind of options contracts on that. I might sell cash secured puts because I'm like, hey, if SoFi falls, to $7, give me all the shares. Give me all of them. That's fine. But on the other side, like there could be a catalyst that hits, and we're looking at this, and this big thing is announced with SoFi, and it's like, wow, lending is actually going to grow at 150% this year. I mean, that's not going to happen. Or like there's a major tech platform deal that comes out of nowhere, and people are like pumping SoFi up because the short interest is 15, 16, 17. And we're looking at it and we're saying, hey, I don't know if it's coming back. I want to roll some of these. That's the reason. The other reason why you might want to roll. Do we want to talk some Tesla? Because you mentioned the.
TJ wants a link, so I will send him a link, and we will have TJ on the pod. But the rolling as a tax strategy makes total sense to me. I think that I'll probably be doing it in both a tax advantaged and a non-tax advantaged account. So I'll probably be treating those scenarios differently. I'm just trying to find where.
I'm more aggressive in my IRA or Roth for that reason, because there's no tax implications at all, and I can do the will strategy more aggressively. Now with Palantir, the other factor there is I don't want to sell that in 10 years. I don't like my shares. I'm happy selling my leaps. That's fine. I'm probably going to do it, because I think it's going to hit 45 and higher. Prefer to wait until January, frankly, because then there's absolutely no tax applications this year. But like if we hit 45 this week, it's like, all right, here's my leaps. But I'm willing to take a loss just to keep my shares, and that's why I'm so careful with the selling of the cover calls on that. It's still worth it, but yeah.
Let's welcome on TJ, the wheel deal.
What's up, Ed? How are you guys?
Good.
Roy, I'm losing some of my fried cauliflower weight.
Nice. You're looking good, man.
Oh, actually, before we get into this, since I have you both on here, I should probably have this chat offline, but I want to have it online. So I'm probably going to be doing a little bit of traveling over the next couple of months. And I called Matt yesterday, and I said, look, man, the Tyson fight is on November 15th. I want to see Tyson fight. I think I missed that era. It's in Arlington.
Yeah.
If I can pull through to be in Texas November 15th, would we want to get a group and all go? I think me and Matt are down to drive to Arlington and go watch the fight. It's on a Friday night. Roy, TJ, you both are Texas based.
Yeah.
When is this?
It's a 1 hour flight for us. I just got to talk to the missus, because we're going to be in San Diego in a couple of weeks. And then we're going to Utah in December, and then New York in February for some Wheelers meetups. But I mean, I don't think I'd have to twist her arm too hard to do it. Is there tickets to be had though? I mean, because the stadium's huge. I would think that there are tickets to the fight still.
Yeah. When I last looked, there were tickets. I got to figure out like flights and all that. But it's on November 15th. It's a Friday, Roy. It's at the stadium in Arlington. I didn't even know that it was that big where they had to take a flight. But Matt was like, yeah, we can drive. It's, like however many hours. And it's like hours. Like it's, it's like right beside you on the map, dude. But
Texas is big.
Yeah. Look, man, if we can pull it off, I'm excited. I want to see Tyson kick the shit out of this guy. But we'll see. He's 58 years old.
Yeah, dude. And Jake Paul can punch, dude. Like, I know he's a YouTuber and stuff, but I've done mixed martial arts for a long time. And he can be a lot of things, but he also punches like a mule. And Tyson is 58 years old. So I'm totally cheering for Tyson. If this was even 5 years previous, first of all, Jake Paul wouldn't be in the mix, but Tyson would definitely kick his ass. But I saw Tyson fight Roy Jones, a couple of years ago in an exhibition. And they're washed out. Dude.
That was disappointing. Yeah, I saw that too. It was like a 1 round type of fight, and then they were like gassed.
Yeah, but If he hits him one time, dude, power's like the last thing to go, right? And you saw George Foreman become the oldest heavyweight champion because they still can pack that punch. And if he hits him in that sweet spot, dude, Jake Paul, we'll see stars.
Dude, there's over a 30-year difference between them. I think Jake is like 27 and this guy's 58. It's going to be wild.
Yeah, but the intimidation, I think, is still there. I mean, just that I would want to get in the ring with Mike Tyson. I'm afraid of it. Just his whole presence, dude.
Yeah, dude.
Scarred me. It's like watching Jaws as a kid. You're like afraid of going in the ocean because of that damn.
That's his whole persona, though. Like, the dude can be 88 years old, and I still wouldn't step in the ring with him. Like, fuck that.
Yeah. I'm afraid of him, dude. I don't even want to be around him. He freaks me out. So,
but okay, if we can pull it off, then let's go watch this fight, man.
Yeah, for sure, dude. I'll talk to the wife. I'm sure that we could definitely. We could definitely manage it. Hopefully, we just get some decent tickets. If not, I mean, just the fact that you're in the arena. The cool thing about Cowboy Stadium, dude, is there's a huge ass screen in the middle. So there's like, I mean, I don't know exactly how they would set it up because usually the Cowboys play football there.
Mm-hmm.
But again, I haven't been to a martial arts or a boxing match there. But if we have access to that really big screen there, dude, there's not going to be a bad seat in the house.
Yeah, I think that's also the stadium where they're going to do the finals of the World Cup. That's also coming up in North America. So it's going to be good, man.
Yeah.
But yeah, ask her and then see what she says. And Roy, same goes to you. And then we can look for some tickets. The tickets are surprisingly fairly cheap.
I'd imagine what, $200 or $300, depending on where.
Yeah. And I was like, dude, $300 to watch Tyson. Like, I'll book a flight and a ticket for that. You know, it's gonna be fun. We'll make a night out of it.
Yeah, I'm down. I think that would be super, super cool. Nice little. We could do it like a long weekend type thing in Dallas. There's a lot of cool stuff to do. But anyway, what's going on, dude? I know you got a text message from you. It was I don't know. It felt like it was over the weekend or something. It was at night, and you're like, dude, my broker's getting their finger out of their ass, and we're in business.
That's
you're able to
almost verbatim what I said. Yeah, man. I really just want to start doing it and learn more about it, like as a learning experience. But I also have like a giant fucking Tesla position that I want to, start making me some money. Sure. With SoFi, I don't really want to do it like that much because of the premiums. Like that scares me. For me to, sell 10 contracts or whatever on SoFi.
It doesn't move the needle.
It doesn't move the needle. Yeah.
It does on Tesla though. It does on Tesla.
Oh yeah. Yeah. I made a lot wheeling Tesla. I'm not doing it right now. But it's such a good stock to do that if you're into that sort of thing.
Yeah. So I think the biggest thing that you have to figure out when you want to embark on this journey, and this is the best way to get into selling options, is to sell covered calls on shares that you already own.
Yeah.
Because there's no investment on your part necessary. You already own the shares. And obviously the qualifiers, you need at least 100 shares, right? To be able to sell a covered call contract. And in its most basic raw form, it's simply a limit order on steroids to sell your shares at an X price on an X day. And they're paying you to essentially collateralize your shares, right? So you're like taking your shares to the pawn shop. You're like, hey, this is what I'm going to sell them for. And on this price, it's either going to be above your strike or below your strike. If it's above your strike, then it's in the money. If it's below your strike, it's out of the money when it's a covered call. But before you do any of that, you have to be clear on two objectives, I feel. The first one is, what is the goal? Is the goal to rent your shares? So you're essentially renting your shares, right? Is the goal to just rent your shares and bring in some static income to collect rental income premium?
Mm-hmm.
Or is the goal to collect premiums when the opportunity presents itself, but to really not run the risk of having my shares called away? That is the fine line that you have to figure out how to navigate. And a lot of people are very unclear. So covered calls can create a lot of anxiety for you. They weren't clear on the front end. What is your objective? Do you want to hold on to these shares for the next 3 to 5 to 10 years? And I'm going to say be very, very strategic. Wait for an RSI of about 70, which indicates oversold on that particular stock. And then start selling some covered calls in like the 15, 20 delta range. If you're like, I have $200,000 worth of Tesla and I need to treat it like a condo and I want to generate annualized premiums of about 25%, because it could also act as a hedge to the downside, because Tesla's been kind of flat, right, for the last couple of years. Bring some money through the door because I got a shitload of dead money here. I want to capitalize on some upside as well, but I can manage this covered call if I'm okay exiting in 3 to 5 years. Because here's the issue with rolling covered calls. The reason that people do not like rolling covered calls is they don't know how to manage. They don't know when the opportune time is to roll. I'm going to tell you guys the cheat code. It is when your break even is breached. So if you have a covered call at 250 and you collected $10 in premiums, your break even is 260. The opportune time to roll is when Tesla hits 260, because you're going to be able to roll out and up for a credit. If you wait till Tesla's 300, you're in the hole. It's like gravity's pulling against you, bro. You're fighting all of these forces, and it's going to be real hard to roll for a credit. You're going to be looking to roll for a debit. So you don't want to get into those sticky situations. So learn some hard, fast rolls along the way. But you got to ask yourself, what is the goal? Is the goal to bring money through the door, to essentially create a dividend on steroids? Because that's what covered call premium becomes. And understand the risks involved. As Tesla moves to 400 and you're stuck in a covered call, the reason that that's very painful for a lot of people is because you lose your liquidity. So when I am long a stock, that doesn't come into the equation for me, because I don't give a shit if I have to manage this covered call for 3 to 5 to 10 years, because I don't want to sell the shares. Does that make sense?
Yep.
So I don't mind managing my covered call because I'm legit long the stock. But if you're selling covered calls on Palantir at like 42 right now, because it's tempting to do so, because the damn shit is overbought. If I've ever seen a stock that's overbought. But at the same time, the trend's your friend. Don't fight the current, swim with the salmon, all those things. There's no reason why Palantir can't go to freaking 50 in the next month with all the hype behind it right now. They just need a couple of good contracts. The guy keeps going on CNBC and shit. Maybe Karp goes on Kramer. I don't know. You know what I'm saying? Like, there's anything can move the needle on that stock right now is what I'm saying. Right. If you want to reserve the right to exit your shares here pretty soon, I would not recommend selling covered calls. Because you're going to be in a situation where you're real pissed off at yourself potentially.
I think for me, my situation is going to be both of those scenarios, because I'm going to be doing this in a tax advantaged account whereby I'm okay to let go of the shares, but I'm also going to be doing this and I'm also going to be doing it in a taxable account where I'm going to be, the strategy is going to be slightly different from a risk adjusted perspective. And so in the tax advantaged account, like, that's where I hold the majority of my Tesla. The majority of my Tesla is in that account. The problem, PJ, with that account is because it's tax advantaged, I only have a small level of new money that I can put into that account. Right. And so, like, January comes around and I can add maybe like 7K to that account.
It's like y'all's Roth, right? It's kind of the equivalent of y'all's Roth. Is that what you're saying?
Exactly, right? And so I end up buying all these stocks on January, and then it's like, Jesus take the wheel in terms of if it goes up, down, or in circles. And so I want to be able to adjust some cost bases down. I want to be able to buy some leaps on some positions and just have that liquidity going around, because it's tax advantaged. Whereas with the other account, it's more going to be opportunistic. It's more going to be like, hey, when is there a good opportunity? When is there liquidity? When is there, momentum? Like, if we have a massive green day, that's when I'll be looking to start writing those calls, so on and so forth.
Right. So you see, the thing is, you have to have a very well thought out strategy. It's almost like you're creating a pro forma for a business, right? So a lot of people don't fully understand my strategy yet because they don't pay close enough attention. And that's okay. It's not for you. But I sell very aggressive covered calls because I need that premium to finance my leaps.
Right.
Because leaps can run forever, right? Unless you hamstring yourself and sell covered calls against those and create what's called a poor man covered call. And
do you ever do?
If you don't manage those right, you'll end up poor, right? So I call the poor man.
Yeah. No, I was just telling Tevis about that. As like, that's what I'm doing on Robinhood, just because I don't own any shares.
Right.
It's all leaps, deeply in the money, but like those, like right now I'm actually down because I sold 25s and it's 25.61. Like it went up 10% today. It's awesome.
The covered call. Yeah.
I will exit at a loss on the covered calls and a massive gain on the leaps. Like
right,
it can keep running, and that's great.
You have to close it yourself on Robinhood.
Yes.
You have to close the covered call, take the loss there, and then immediately sell to close the leap because you bought to open. You sell to close the leap to realize an overall net credit. If you do it the other way, you have the shares get assigned. It really sucks, dude. Because what Robinhood does is they'll exercise your long call and absolutely screw you. And when you're up on probably like a grand or 2 or 3 overall in your position, you actually have a net debit overall because Robinhood is not your friend.
Yeah, no, I mean, they are your friend, but like not in that way. No,
not in that way. They're going to do what's best for them.
And you almost never want to let those go into expiration anyway. So yeah, I like if we hold this price, I'm manually doing it. The one piece that also, if somebody is listening, paper trade it, practice with it. These are trickier than covered calls. Is you make sure you have the collateral to close out of that covered call, because if you don't, you're between a rock and a hard place. Like it really can blow up. Maybe not blow up your account, but it can really hurt you. So especially if you don't have deep.
I have a poor man covered call campaign on PayPal as well. I have a position, but I also bought leaps and I sold calls against those, and those are actually underwater right now. And you can roll the covered call if you're comfortable doing that, but you might also be compounding your losses later. And it comes down to delta. Like you got to be able, like if you're going to do a poor man covered call campaign, you got to make sure that you understand the overall position delta of your account. So like if your leap is like at an 80 delta, you probably want to be selling covered calls no higher than a 20, so that you have an overall 60 delta. Because what that means in a nutshell is you don't want to put yourself in a position, guys, where the money that you're making on the covered calls or the money you're making on the leaps is being offset by the money that you're losing on the covered call. You want to continue to have at least a net gain of like 40, 50 cents on the dollar, if that makes sense. So if you can continue navigating it that way, then you can continue to roll your covered call and have a lot of success doing that as well. But it just really, just depends on what it is that you're trying to accomplish. I do cover calls on just about everything unless the stock is severely undervalued. Then I have to pick my spots. But whenever I'm still building out a position, like on SoFi, I'm almost completely done building out that position. I just need to buy 400 more leaps, the 15 lottery leaps for June of 2026. I bought 100. I got to buy 400 more of those lottery leaps. And that position is completely financed and paid for at that point. Whenever that is achieved, then I will no longer be looking to sell covered calls just for the sake of collecting premium. I'll be picking my spots a lot more the way that Roy does in his strategy. He waits for Palantir to be like at prices that don't even make sense to him. And he's like, dude, if you want my shares at 50, you can have them at 50 type thing. And I'm just going to essentially get this money that the options gods are leaving on the table for me. So TJ, I don't understand how those get filled, to be honest with you. Like the kind of options that you guys sell, Mad Money does too. I don't even know how you guys get filled half the time. It's crazy to me.
Can we walk through an example, TJ? Because I really want to actually see this in action. The assumption here is I'm okay to let go of the shares. Okay, let's run with Tesla where it is right now, because that's going to be probably where I'm going to start. And let's assume 1010 is not coming up, that there's no major catalyst coming up. I just want to know what TJ looks for, how far out from a time perspective, how far out from a stock price perspective, what are the main indicators that you're looking for? And just walk me through your thought process as you're looking at these options, assuming that you're okay to let go of the shares, but also assuming that this is just rent that you're collecting.
Yeah, sure. So can you share the screen real quickly? Because I have Tesla positioning.
Let's do it.
And my position on Tesla, guys, is not going to make sense to you guys unless you understand that I also have a TSLL position, if that makes sense. Fair enough? Just full disclaimers on the front end. So I'm going to walk out on my Tesla position. And the reason that I have it set up that way is because I just looked at all the math for the last 2 years and I realized I can make a shitload more money with less capital on TSLL. If Tesla's going to trade at these levels, I'm going to go get twice as much premium on TSLL, and I'm going to be able to control a lot more shares over there. And I even get a nice little divvy for my troubles as well. So it was just an extra spoke on the wheel. So essentially, I chose not to continue to keep building out the Tesla position to 5,000 shares. I stopped at like 2,500 because I was making a lot more money on TSLL.
Got it.
So just keep that in mind. But let me walk out through the Tesla position and what I did. And then I'll show y'all the TSLL position, because any money that y'all think that I'm leaving on the table on Tesla, I promise you I'm making twice over on TSLL. Just disclaimers, right? This isn't financial advice. I'm not a financial advisor. 2 of you have already tried to sue me. I'm sorry that you suck at selling options. Watch my channel. That is my disclaimer. What do you guys want me to do? You push your own buttons. You live with your results, okay? So here's the thing. So what do we got? We got 2,500 shares at 196. So I'm up 24%. So not the greatest entry point, but it's not bad either. And I'm of the mindset that I want to be in Tesla till 2030. So that's kind of the foundation of the position in a nutshell. I'm in an okay position. I wish that this was more like a 150 entry point, but it is what it is, right? So I have entered into selling covered calls against these shares at $280 for January of 2026, way out in the distance, because I looked at the chart about 2 months ago and I was like, I love me some Tesla, but it's kind of done sideways for a really long time. So I wanted to grab a lot of premiums so that I could help finance the TSLL position. You follow me? Because I got paid a ridiculous amount of money for doing this right here. So I can pull up this right here and you guys can see just on the latest roll, I got 40,800 to do that because I wanted to finance some TSLL actions. So just full transparency all the way around here. But what I also have going on here is I have 15 leaps. I've agreed to buy 1,500 more shares at $150 on or before January 26th. And I fully intend to exercise these next November, December, when all the theta comes off the contract, or the majority of the theta comes off the contract. So this will now be 4,000 shares at an average cost of probably 175-ish, give or take, right? 180. And I'm going to then babysit these until the year 2030 if I need to. And I am not interested in selling Tesla unless I can do so for a minimum of $500 a share. And I have the capital, or will have the capital, God willing, to turn these leaps into actual shares, because I'm up substantially on those leaps right now, as you guys can see. So I don't want these shares to get in a situation to where they're called away from me. So that's why I essentially created a debit spread on this part of the contract, because I have the leaps and the covered calls on the same expiration date. So now if I was wheeling this right now and I had shares of Tesla like Tevez does, and I want to just bring some premiums through the door, but relatively safe, because I don't want to have to monitor the position too much, then I would be looking to do something. I would look, first of all, for a binary event. So if there's earnings coming up, I want to stay away from that. And obviously, you have the 10-10 event as well, but let's just forget about all that for a second. My sweet spot is 30 days for me, because I don't like to manage the positions that often. And then I would probably be over here in that $300 range, because that's probably going to be about a 15 delta. That's an 18 delta. And then there's plenty of open interest in volume. There's a decent amount of implied volatility, but it's not too crazy. It's not like the Bitcoin miners. So essentially you're saying, hey, here's my shares of Tesla. You can have them a month from now at $300. And for your trouble, they're going to give you $455 a contract.
So let me one question real quick there too. The premiums are usually not that good, but the IV is significantly higher, partly because of 10-10 and earnings is a significant one. So
Right.
usually you would not get that from a month of your trouble, but in this case you can.
Tesla, you got to learn your stock, right? So Tesla is usually good for about 55 to 60% on the IV. It's pretty. That's why people like it so much, because it is a condo on the beach, and people pay premium to stay at that condo, right? Like it's like, to me, there's different types of stocks, right? There's stocks that are in very boring, safe neighborhoods, and they pay very steady rent and premium. And then there's going to be your sky rises, downtown New York's, the Miami's, at the beach, etc. Those condos can command a higher multiple for rent. Well, it's the same thing with stocks that are more volatile. They're going to command a higher multiple for your rent because you're renting those shares, right?
So when you're looking at a price, so you said, okay, 30 days out, you don't want to manage it that often. I get that. When you settled on 300, is the delta the main thing you look for to determine what price you want to go after?
In this case, what I would have done on the front end already is studied the chart and looked at where the supply and the demand was. So I would look for really, really big red bars on the top, really, really green bars on the bottom, because the really, really big green bars, those are demand zones on the chart. And the really, really big red bars, those are your supply zones. So essentially, this is where all the crackheads are trying to buy the shares. And this is where everybody's like, hey, you can have these shares because I'm taking profits. So I go back a year and I study where's the big red bars on the top? Like, what's the resistance? Like, why can't Tesla cross over 300? Because 300 has been a problem for Tesla for over a year now. Because I study the charts, right? Y'all can look at the charts, call me a liar. I mean, look at it, it's there. Tesla has not been over 300, maybe like a day or two in the last year, if any. So it's just real hard for it to go over. And it's also a psychological level now for the market. And then I look at my bottom is probably where all the supply is. I haven't looked at the chart here recently because I made these bet and now I've been going to TSOL. But I bet the demand zone is probably in the 150 range. Like if Tesla goes to 150, people are just like, I don't give it. I'm buying this thing because I know I'm going to make money eventually, right? So I want to be at the high end of that supply zone. Okay. And you can look at your Bollinger Bands, and if you put a Bollinger Band on your chart, you're going to see that it's probably going to be the higher end of that Bollinger Band is going to be right at around that $300 level. I bet if I put it on the chart here on Robin, and I can do that for you guys if you want. And then I would look for like the RSI to be like closer to 70 and stuff. You're looking for like opportune times. But if I'm just like, I don't want to do all that, I'm just going to rely on my delta. The delta is it's a real nice way to do it, because that is about an 18% chance that you would actually have those shares called away from you the way the market sits right now.
Okay, so
essentially probabilities, I like the probability that says 82% of the time I'm going to win this trade. I'm going to keep my shares. That's a win. And the premium, no matter what happens, that's yours on the front end. So that's already a
win. Okay, so go ahead. The delta is just the percentage chance that these get called away.
Yeah, so delta has two functions, right? The percentage, that's like the short form way of what it does. It's like the cheat code. But really what delta is for every dollar that the underlying moves up or down, that's the percentage that you're gaining or losing on your delta. Because that's the options price, right? So if we look at that options price, it's 455, it's an 18 delta. So if Tesla goes up $1, right, and it's a covered call, you're losing 18 cents. If it goes down $1, you're gaining 18 cents. It's inverse, because the further it goes away from your strike price, the less probability that you're going to get assigned those shares, right? Okay. So it stands to reason that your delta is going to get less and less. If Tesla crashes to like 220, the probabilities of it going to 300 are probably now in the 10% range. And then your gamma is just the accelerator to the delta. So every time they reset the delta after every dollar in increment, that gamma is going to get added or subtracted to your delta. And then obviously your theta is just how much time you're collecting on a daily basis. And then the vega is related to the implied volatility, and the rho is related to the interest rates that the Fed sets.
With regards to the time frame, do you switch it up often, or is there certain time frames you generally stick around?
I definitely like to do 30 to 45 days, and I like to manage 21 days out. It's a tasty trades away. It works really, really well because the first 50% of your contract is a lot easier to capture than the second 50%. Because whenever you get closer to expiration date, Tevis,
Mhm.
these forces, your Greeks, everything gets amplified. Everything is like it's D-Day, right? So these gamma, the theta, the vega, and the rho, they all have a function. They're like worker bees, and their job is to get that delta to -1, 0, or +1, depending on if you have negative delta or positive delta for the position. So they have until expiration date to make that happen. So if you're like sitting here at like, at 100 or -100 in this case, because it would be negative delta on a covered call, then it's going to look like 100% chance that you're going to have to you're not going to be owning these shares anymore, or it's going to look like 0. And I can show you all examples of what I'm talking about. That way this can kind of hit home, because if you don't understand the Greek sky, you shouldn't be selling options. Like I'm going to say for the people in the back of the class. If you don't understand the Greeks, you should not be selling options.
And I do weeklies mostly, or sometimes 2 weeks out. It is less lucrative, but basically what I'm doing is selling Vega and selling Theta. So I'm selling time and I'm selling volatility and just waiting for that to tick down to 0. For me, that's a lot safer, because if it's a position I don't want to exit, there's a lot that can happen in a month. There's a lot that can happen in 6 weeks, 8 weeks, 10 weeks that I don't know. And so I like to control that. And usually by selling weeklies or every other week, I have a good idea of what's happening on the horizon. It's also nice because you miss the weekends, and some positions, like if you're selling options on miners, you can make a ton of money over a weekend and it just flies up. You can lose a ton and you have no control over that. So sometimes you don't want to be in it over a weekend.
I'm curious to hear from the both of you, maybe less so on your side, Roy, because the time is shorter. But like if I am going a month out or 45 days out, how often do you sort of buy that back to close it halfway through, and how often do you let that ride all the way to expiry?
So it comes down to the time value of money tokens. Let me give you some examples. So I have a Riot cash secured put here where it tied up 280 grand on Riot, and I said, hey, if Riot goes to 7, give me those shares, right? 40,000 shares at $7. And I've already in a situation where I've captured almost 60% of that contract. I entered into this contract on 9/25. It was for 10/25, so a whole month out, and we're less than 2 weeks into that contract, give or take, right? We're at about the halfway point, and we've already captured 60% of that. So the math says if I want to close, it probably wouldn't be the worst thing, because I'm essentially using 280 grand in about 14 days of the trade, and I'm able to make an $8,800 profit if I'm willing to give, because they paid us $8,400 on the first set of contracts and $6,400 on the other. So I can essentially give $6,000 of that back, free up all the collateral if I have somewhere else that I'd rather put the money. And that's the key right there. If you have somewhere else that you'd rather put the money for the same time frame, same collateral, but you're going to get more premium, and it's a trade that you feel just as good about, or not better, then you should probably make that lateral move to capture more delta.
Got it.
But if there's nowhere to put the money and it's a super safe trade in your mind, I know Riot at 7 might not be good for you guys, but I study this company about 15, 20 minutes a day. For me, that's a lot, trust me, because I don't like to research. So to me, to devote 15 to 20 minutes a day of my time, bro, that's like gold in my mind. So I'm like, there's nothing that can happen with Riot right now that doesn't make me want to take ownership of those shares. So my thing is, why am I going to give you back that 6,000? I've got a glorified savings account that's paying me another $6,000 for a couple of weeks just for doing nothing. And I kind of hope that Riot goes down to like 720. Put pressure on my cash secure put. Why? Because then I can run it again for another month, and maybe you put a 650 handle on the next batch and collect another 14, 15,000, and I'm tying up less capital. It's a better return for me, and it's a safer entry if I truly want to own those shares. So when it's a cash secure put, your mindset has to be like, dude, I want to own these shares. What's the max that you'll pay me to park my money there? Right. And if your mindset isn't that, you should not be selling cash secure puts on that underlying. There's too many people out there cash grabbing. Roy, call me a liar, brother. I know you're a bit of a preacher, man. There's a lot of people cash grabbing on underlyings because their premiums are so dang good, but they have no interest in actually owning those shares. That is the recipe for failure in the stock market. Selling.
Yeah. I talked to Tevis about that earlier, and basically I said it's like, because he understands dividend stocks, it's like going into a company only because of the dividend yield. That's a terrible idea almost all the time.
That's a horrible mindset, dude.
Yeah, you just can't. You can have goals, and it's fine to have goals, and I think you should. Well, you actually need to, because TJ's strategy, you're after something different. TJ, your strategy, that's how you make money. Me, it's just how I get a little bit of extra.
Of course,
and I don't want to sell.
You're essentially like, it's almost like a cherry on top mentality type thing.
It is.
Where you're like, hey, like I'm cool with the cake, everything's good here, but any premiums that come my way, it's like found money. It's like, have you ever like washed a shorter panty, you found like that $20 bill? Doesn't it feel like amazing because you just didn't know that it was there? And dude, it happened to me recently when I was going through some polo shirts that I was wearing for golf, and it was $100 bill there. Kristen thought I won the lotto, dude. I was literally like yelling, like, "Oh my God, dude, there's $100 in here." It was the craziest thing. Well, that's kind of the way that Roy plays premiums. He's like, dude, I didn't expect this money to be here. And it's super, super exciting because it's hard to find a downside if he's going to sell a pound here at like $50 or something right now.
TJ, for your portfolio, because it's all centered around this strategy, do you actively discount stocks or select stocks based on their volatility? Like what premium you could juice out of them? Like, for example, like SoFi in my mind is a company that I want to hold in the long term, but it's not a company that's going to give me as much premium as Tesla is. So why would I ever be in SoFi versus Tesla? Like if my entire portfolio is around Wlky.
Right. So Tesla, so that is not true. If you look at the options chain on SoFi, we're going to take that same, so what was it? 31 days, I think, right? Is what we decided on the last one.
Yeah.
And we're going to go like say 16 delta. So that would be like right over here, maybe.
And as you're looking, just a reminder for folks, the earnings call is during that time frame. So that's why the premiums are.
Yeah, because the earnings is over here. So if you wanted to get some of that action, you probably want to be doing this guy right here. You're going to see that the IV should be a little higher. You see 68? It's very similar to what Tesla's with it, I believe. Tesla was like, what, 65, 66, something like that?
Yeah, Delta's the same there too.
Yeah, so this is very similar. So now you got to look at the math, right? So this one's $13. Doesn't look like a lot, but it doesn't cost, it's not the same capital either. So you got to take the $300 and it was paying $455 and then do the math. How does that stack up on $13 at 1,000? Right? Because this is going to be worth $30,000, right? At 300 for 100 shares, and this one's $13 on 1,000. So you're probably going to find that the math isn't that. It's probably going to be pretty similar. I'm not like one of those math geeks to where I can tell you like off the top of my head. But
I think it more applies to me than to you, because for smaller positions, the commissions will eat into like a SoFi, for example, where I'm buying way more contracts than a Tesla. Like that commission check, especially in Canada, is going to eat into that profit for that premium. So I'm better off to buy like high ticket item or the blue chip companies because they're more expensive and I get to buy fewer contracts as a result.
Right, I get it. Like I have cover calls on SoFi right now, and it was I got $14 a contract at $9 for 1029 because I looked at the chart and I was like, dude, SoFi is going to have a real hard time crossing over 9. If it does, it's off to the races. But I'm willing to place a little bet here to pick up, $7,000 that I don't have, because I also have all the leaps that are protecting me. So to me, it didn't make any sense mathematically to leave the shares part there, because I've got all of these leaps over here at 10, 7, 5, and these are the lottery leaps that I'm trying to build out. So there's 1,500 contracts there that are protecting me. So I'm not going to have all of this money tied up and not bring in any rent because I feel like SoFi's undervalued. I'm not maximizing my premium or anything. Like, to me, it's just like, okay, you paid $1 million for this damn house. You got to bring some money through the door, because then if not, by definition, I have dead money there. But,
so, okay, let's continue on. Like I'm taking notes, by the way. Sure, and yes, it is like I'm actually taking notes. So in our Tesla example, we selected 300.
Right.
Let's just say, let's go through that. We collect 450 in premium or whatnot.
Right.
What do you then do with that money? Like the options to me are you buy something else in your portfolio for a long-term hold. You buy more Tesla so you can compound and sell more options later on, or you buy some long dated like leaps, for example.
Yeah. So the first thing that I would do in a cover call campaign with an underlying that you first of all don't want to sell is I would finance leaps with those cover call premiums, because then you created a no lose situation. If that cover call gets in trouble, who gives a shit? Your leaps printing money. And now you can become very, very indifferent. And you run that successful campaign 3, 4, 5 times. Now you're sitting on 10, 15 leaps on Tesla that you didn't have before with other people's money. My God, I know you're Canadian, but that's the American way. Doing shit with other people's money, Tevis. That's how this country was built.
I love it.
Collecting premiums to finance leaps is the best use of capital for covered calls, because you're in that stock. Surely you're bullish. But when you want to buy leads, now you want to look at your IV. That's the most important metric. And you want to wait for a situation where the IV kind of like wait after an earnings report, and then they have what's called IV crush. Mm-hmm. Those are opportune times to buy leads.
And one other thing to keep this in mind too is, we already talked about really only doing this in companies that you're interested in owning, because you could get stuck. But it can make sense even if you're looking at SoFi and you're looking at Tesla. And I know you know Tesla pretty well, but let's say you only knew Tesla like a little bit, like you know of it, but you don't know about like the energy sector, and you're not sure about full self-driving, robotaxis, all that stuff. And, so you're a novice on that, but SoFi like you do. It can even then still make sense to just stick or really focus more on SoFi, simply because you know what catalysts there are, what dangers there are. We know what certain levels it's likely to have trouble breaking past, instead of something out there that looks attractive, but you just don't fully understand. So like HIMS, it's a new position for me. I'm selling. And actually, that's another topic. But I'm being a little bit more careful with that, because I'd like to have that long term, but I don't know it as well. We're about to have HIMS Weekly here in about 30 minutes. And there's a lot that I don't know. There's a lot that I'm learning every week. It's a fun place to be. Now, the other thing, too, to keep in mind is there's some companies like HIMS, and Robinhood actually used to be this way, too, that there's just not that much open interest. And open interest is the number of people looking to swap that contract. And they can have price points all over that contract. But if you don't have a lot of open interest, the spread between asking and bidding is wide. And it can be tough if you want to close out that position early.
Yeah, and I don't like those stocks that are like 5-cent increments either. Those are typically lower liquidity stocks. So that's why I love the SoFis, the miners, the Palanters of the world, and Tesla, because there's more contracts that you can ever afford to sell. You're never going to have a liquidity issue there.
I know Roy has to bounce in just a few minutes here. So just take a moment to say, we're doing HIMS Weekly in 30 minutes. So make sure you don't go anywhere. It's going to be on this channel. It's going to be with HIMS content creators. I should actually share the link with them. And so Roy will be back in 30 minutes. But in the meanwhile, I want to keep going with TJ for maybe another 10 minutes, maybe 15 minutes, TJ, if that's okay. And just ask some just questions that I have, starting with this one. What if you sell cash secured puts with the premiums on another position?
You can totally do that. Just make sure that you're tracking everything. This is a business, guys. You want to treat this like a hobby. It's probably going to end up costing you money in the long run. If you treat it like a legitimate business, you have your credits, your debits, etc. I mean, all of my money here, it's all commingled. At the end of the day, it's all one big pot, right? But you want to track, like, how many credits, how many debits have you had in this particular position, so you know where you stand. And what I mean by that is you've got to know what your adjusted cost basis is on every position, because if push comes to shove and you need to make some very difficult decisions, it's probably better to exit out of a position that you're not so underwater on, especially if you think that there's a chance of recovery. Like, why would you want to sell that position? It's better to maybe exit another one and you look at like your conviction levels as well. Like it just turns out for me that my lowest conviction stocks are the ones that I have the best cost basis on. It kind of sucks. You know what I mean? Whereas with my higher conviction stocks, like I'm still working to try to manufacture that win. So I think that's perfectly fine. I just gave you all one suggestion on what to do with the cover call premium. Another thing that I used to do early on is I would just buy more shares at the underlying, because I felt like I was literally using other people's money to build my position. And I would say probably 50% of the shares on SoFi have been bought with premium.
Yeah, I love doing that. It feels like cheating, honestly,
It does.
because then you also get more position, a higher number of shares, and as those hit the 100 lot increment, and my account's a lot smaller than yours, you do the same thing, and it's a self-feeding thing. It's awesome. TJ also has a really nice Excel spreadsheet that he uses. I'm sure he'll break that out if you'd like him to. I use that actually now. I've tweaked it a few things. I'm no Excel expert, but it's helped a lot to track, because before I kept loose track. Now I keep track of everything, and it really helps to know exactly where I'm at, where my risk is at, where I'm doing as far as my goals. And I do have goals, which right now I'm smashing through right now, because it's been a great year for option selling. Just like it couldn't be better, almost Goldilocks. Anyway, on that note, I got to go. Keep learning, Travis. Keep learning, CJ. Just kidding, guys. Love
Thanks,
you.
Ron.
Have a great rest of one.
Appreciate you, Roy. Take care, brother.
That's great. Dude, I will definitely ask to take a look at that tracker as I get into this. I'm really curious, man, because this whole year, I've run this entire experiment portfolio, and I've funneled quite a large amount of money into it, where I've basically bought safer / boomerish positions, and seen the dividends roll in. And that's great. Like, I love getting money for doing no work, because my broker hasn't really allowed this. And now that my broker will allow this, what I was telling Roy before was that I just want to have that same portfolio. Granted, this is not a tax advantage account. Right. I want to have that same portfolio be in maybe 4 or 5 good positions, like Meta, Amazon, Tesla, QQQ or something, and just sell calls on those on a recurring basis.
Yeah. And you can shoot, like when I sell covered calls, I look at, am I generating at least 25% annualized return on my capital? If not, it's just not worth me even entering the contract. Because if I'm going to create a potential headache, I better be getting a sufficient return on my investment, return on my capital, cash on cash return, whatever fancy metric you want to use. At the end of the day, if I have $100,000 worth of those shares, and if selling that covered call contract doesn't equate to as if I was getting 25,000 in one lump sum, just to give you guys how the math works, I'm not doing that contract because it's just not worth my time.
So that 25%, that's at the end of the year when you do all the books and you're like, okay, my entire portfolio is 100,000, let's say. Yeah. If I didn't make 25,000 from selling covered calls, this endeavor wasn't really worth it.
Puts. Yeah, or puts. So I want to do an exercise. So this is the amount of the portfolio was 3.194 when the year started. Then there was capital injections all the way up to 5.25, where we stand right now. That's the capital injection. The rest of it is money that's been generated in the portfolio via premiums and or capital appreciation. How much gross premium do you think has been collected in this portfolio for the year?
What did it start at?
3.894 when the year started.
I'm gonna go $500,000.
No, maybe last month.
Wait, what?
Maybe last month. No.
All right. So how much premium?
Well, let me look at it. I haven't looked at it today.
Jesus Christ, man. I ask you to explain something to me, and then you show me all these values, and you totally take me out of it. I'm like, okay, well, I don't have 3 million to put in Tesla and 1.2 million.
Here's the total credits, 3.240. That's the total premiums collected in this account for 2024.
That's just this year?
Yeah. And here's all the trades, dude. Here's all the trades. And I don't put tickers or anything next to them because then it gets emotional. So I just look at credits, debits. I look at, so it's right here, right? So I look at Leap's cost, the Leap's value. So there's an unrealized P&L there. The share cost, share value, unrealized P&L there. And then I bring it all the way down to line 700 because I shouldn't exceed that many trades for the year, and I'm getting close. So I have the total credits, total debits, the leap cost, leap value. So I'm up on the leaps, the share cost, the share value. So I'm up on the shares. And then I have the open collateral and the money value. So if all the options expired right now that are puts, I have to buy another $1 million worth of shares. And that's important because the brokerage cash is 1,222. So this number always has to be bigger than this number. If not, you potentially tap into margin. And then if I needed to make a withdrawal, that's how much money is withdrawable on the account right now. So those are the metrics that I keep. These are not on the tracker, but that's important for you to know if you're going to treat this like a business, is where do you stand, right? Like, where do you stand on the shares that you own versus what they're worth? Where do you stand on the leaps, what you pay for them, what they're worth, how many credits, how many debits? And the reason that the debits are so high is because the $964,000 that I spent on leaps has to go on this category here. Had it not been for that, like next year, there will not be that expenditure. So I'll be capturing and keeping more premiums. I wouldn't be giving them back.
What maybe we can answer this. I know you said the 25%, but like for somebody like me who's starting this out for the first time, I'm going to be fairly conservative to start because I'm just learning. I'm probably going to start, I don't know, maybe with a portion of my portfolio, not all of it. I don't know, 100, 200, maybe 300.
Right.
What would you say is an achievable return, like at the end of the year? Yeah. And then also,
I know the amount, I know the kind of stocks that you're in, Tevis.
Yeah.
And you should definitely shoot for a 25% return on your premiums for the year. So if you have $100,000, come hell or high water, be a cash secure puts or cover calls, if you're wheeling, if you will, you should be shooting for 25% in premiums per year. And if your stocks stay flat, you're at 25%. If you have some capital appreciation, you might be at 40, 50% for the year. If you have some capital depreciation, you'll probably be at like 10% or negative. That happened to me last year, where I made a shitload of premiums, but there was not a lot of capital appreciation. But this year, there's a lot of capital appreciation. And I've been batting between 25 and 40% annual going on my 5th year.
So maybe just a follow-up question on that before because I have another question in mind on down markets. But how does that?
So Josh's comment on there, that is not true. If you're managing your portfolio correctly, like I do, you're going to get a lot more money in a bear market on the cash secured puts because the pressure is down. So the cash secured put is very, very, very critical. Like right now, the portfolio is a little heavy on share ownership. 66% of the portfolio is tied up in stocks. By the end of the year, I'll be between 40 and 50%, so that I have more dry powder. If we get a pullback, then I'm going to be celebrating because, one, I'm not going to have as much drawdown because I don't own as many shares, and I'm going to be just raking it, dude, via the cash secured put premiums. But again, I do the same stocks over and over and over and over again, dude. That's my watch list. That's everything. It's real hard for you guys to convince me to add another ticker. It just is. Because these guys make me money.
Do you break out that 25% like per trade to say like, okay, 25%, I want to make 1%, per trade on 25. Like, I'm just saying, do you break it out to say, okay,
because of the type of stocks that I have, like Amazon's not going to give me that, right? PayPal's not going to give me that, but Riot gives me like the equivalent of 50 to 60% a year sometimes.
Right, gotcha.
So does Neo. No, seriously. So does Neo. Hood gives you like about 30 to 40% a year. Btlg gives you like 25 to 40%, depending on where you're at. Same thing with Tesla. And then these here on the bottom, guys, those are swing trades. These are not permanent positions in the portfolio. I know that it's CrowdStrike and NVIDIA. They didn't make the cut. I didn't get in early enough. These are swing trades on the bottom. Over here, this is the top 10, right? Like it's actually right here. But BITX and TSLL is interchangeable because BITX is a trade because it's a leverage play on Bitcoin, and I want to be out of it before the crypto winter. So I average about. It's very simple for me mathematically to get 25, even 30% a year in premiums because of the asset classes that I'm in. Now, if I have a bunch of boring shit like AT&T, well, then you're not going to get that, dude. But I mean, I'm trying to go buy condos at the beach, right? That's the kind of stuff that I like to be in because that's what I'm interested in. I mean, if I want like a lot of if I want less volatility and whatnot, well, then just will the SPY. But if you buy shares of the SPY and you sell a successful cover call campaign against that SPY, you're outperforming the market. Congratulations.
Yeah, I guess that's my other question is that, like, if Riot gives you 50 to 60% and Amazon gives you, let's say, 15%, then why are you not more concentrated if you're bullish on both over the long term?
Yeah. So Josh, I don't know, bro. The only thing that I can tell you is what my experience is. I got $5 million from 5 investors and I doubled the account twice. I got paid $2 million on, I got paid 10% on that, over $2 million. And then the only thing that I can tell you is that's what the portfolio has done for the last year. And then I didn't start out good in this portfolio. So, but we're still at 45%. So, and this is the third year in this portfolio. So do with that information what you will. I always play this game, not to be a dick, but you can be right, I'll be rich. I'm just, you know what I'm saying? Like, I don't play that game. Like, I sell puts, I sell calls, I collect premium, and I've been in the exact same market that you guys have been, and those are the results. And those are the underlines. But I know what I'm doing. I'm not just like buying a bunch of Neo. You got to look at my cost basis on Neo, right? Like, people are like, oh, he's in Neo. Well, I'm like, well, fucker, at 468, you probably want to be in it too. I'm just, you know what I'm saying? But you did it and I did. That's the reality. So it's just, you got to look at the totality of it. And I sell puts, I sell calls, I collect premium, and I have a 25-25-50 strategy where my first bullet is always 25%. If shit hits the fan, like Josh is saying, then I deploy the other 25%. And if it really hits the fan and the conviction is there, the investment thesis isn't broken, this is just price action, then I go in super heavy at 50%. And that's why I make money, because my genetic makeup is very, very different. Like, I actually want the stocks to go down when I'm building a position. Why wouldn't I want to buy them cheaper? So to me, if you're telling me that I'm selling cash secured puts and the market's going down and I have a shitload of cash, doesn't that sound like a recipe for success long term if I think that the stock's going up and to the right? Would you rather own SoFi at 5 or at 15? Think about it, Tevez.
Mm-hmm.
But the conviction has to be there. The conviction has to be there, the courage has to be there, and the capital has to be there. Those three things have to happen. If those don't happen, then you don't have a recipe for success, in my opinion.
Yeah, I mean, I'm just trying to think of where that could bite you. And where my brain is going right now is just if you don't have liquidity. Like, if I buy SoFi at 10 and I spend all my money buying SoFi at 10 and then it spends the rest of the year falling, like, I don't want to sell covered calls at 6, but I also don't want to sell covered calls at 12 when I'm in the money, in the green on my shares, because I'm going to get no premium. But if I'm selling, like, if I'm doing cash secured puts, then I'm willing to buy more and more SoFi on the way down and average down. But if I don't have any liquidity, I'm fucked.
But I think that that's the golden rule, dude. The golden rule is only sell cash secured puts on stocks that you legitimately want to own, because you've already decided that you're long on, and you got to manage this like a business. And I'm not arguing with Josh. Josh makes very valid points. I just want to make sure that I'm trying to address that, because dude, you can't argue with what he's saying. He's not being a dick in the chat. He's making very cogent points. This does not work for everybody if you're treating this like a hobby and you're not adequately capitalized. What helps me is I have a lot of courage. I have a lot of conviction. I rely on people like you to do a lot of research. And then on top of that, I'm extremely well capitalized.
That's the thing. Exactly.
That is just the reality, dude. Without the capital, dude, a lot harder, bro. A lot harder. A lot harder. But hey, I treat it like a business. If you can't afford to treat it like a business, I got something for you. Find a hedgeman that will take you on, and now they're treating it like a business for you. You know what I mean? Like, there's reasons that hedge fund managers like myself have jobs, because we're able to get these types of returns. And if you're an accredited investor, you can get taken on. I'm working on one where if you're not an accredited investor, but get all the licenses, you can join that party too. And then now you're able to play with all this leverage and participate in all these returns. But it's tough, dude. I mean, it's not for everybody, but I think you're in a good situation, Tevez, because you're dealing with good underlyings. I mean, Tesla's not going out of business. You know what I mean? I don't think SoFi is going out of business. Some people may think so, but we've all done enough research on it to know that we're sitting on a lottery ticket. We just don't know when we're able to go to the ticket counter yet. And, the Robin Hoods of the world are starting to go to the ticket counter. Palantir's going to the ticket counter, and we're just kind of waiting, like, when's our chance, right? but we know that we're in line and we know that we're going. We just don't know when. In the interim, I sell puts and calls. I collect premium. I roll when it makes dollars and cents. It doesn't always make sense to roll, especially if like you're in a situation where there's another position that you want to build out more, Tevis. You just want to take that capital and move on, and that's okay.
Well, so that's what I was thinking. And this is just on somewhat of an experimental portfolio, which is this dividend portfolio. So full disclosure, I mean, you know these numbers, but the audience doesn't. So that's coming up on 200K right now. And right now I want to be able to just sell everything. And then Jan 1st, start fresh. I got 200K capital. How would you allocate that if that was your portfolio? Like, I've thought about this. Like, why don't I just buy 200K worth of SPY or with a QQQ and just sell covered calls against that? Because I don't really care about the underlying to be super, volatile for me to lose money on the underlying. I could just do it on an ETF, or I can do it on an index, or I can buy, 4 core positions, 5 core positions and do it on that, or anything in between that. So I'm just wondering, how would you do it in that case? You have
what I would do is what I do with the majority of these stocks, and I would run what's called the coverage strangle. So if you have 200 grand, I would look to pick up between $50,000 and $100,000 worth of the underlines if they're at a price that makes sense to you. If they're not at a price, then sell all cash secured puts and build that position, and then you're going to sell covered calls against those shares while simultaneously selling cash secured puts on the same share. And mathematically, you're going to always be winning one side of that contract and managing the other side. And that is how I'm able to achieve that 25% a year with regularity, because the math is on my side. By definition, dude, I have to be winning one of those contracts if I got a cash secured put and a covered call for the same expiration date. I got to be winning one of those contracts if it's a different strike price.
For that amount of capital, how many positions would you look to get in? 5?
5 at the most.
Right.
Because you got to go in it with the Josh Lewis mentality. The shit's going to go down. Murphy's Law, right?
Right.
It kind of does. Because think about it. Let's just do what we're talking. Just think about it. How did I end up selling cash secured puts and covered calls, Tevis? Because anytime I bought a stock, it almost seemed like there was something on purpose, and the stock would just go down.
Right.
And I got tired of it, dude. I got tired of buying the dip that kept dipping, and I didn't have any more cheese. I didn't have any more chips. All I had was tears. You know what I'm saying? And I was like, this sucks. Trying to pick the bottom is very, very tough. Trying to pick the top is very, very tough. So I was like, well, let me just see if I can scale into positions, because maybe I can be right a couple of times on cash secured puts before I get caught my hand in the cookie jar. Well, at least emotionally, I feel like I got a little bit of breathing room here. I've got a margin of safety, which is my premium, versus just buying, holding, and hoping, and then shit dips, and now I'm just waiting for a market recovery, and it's tough, dude, because if shit goes down 50%, it's got to recover 100% to get back to even for you. So the stock math wasn't really in my favor there. So because I realized that I couldn't buy at the bottom and sell at the top, I need to kind of like cheat a little bit and get graded on the curve by selling puts and calls and utilizing that premium. So if I have $1 million portfolio, I'm shooting for $250,000 in premiums for the year. And hoping that I don't screw it up too bad on the shares that I take ownership on. And if those just go flat for me, I could have a 25% a year. If they go up, I crushed it. If they go down a little bit, I'm still okay. And that's kind of the way that I try to manage it in a nutshell.
My dude, I get you 1,000%. You're talking to a guy that has 6 figures in Tesla, and I've been holding that shit for like 4 years, unable to juice anything out of it. The amount of money that I've left on the table is...
It's egregious.
It's egregious. Absolutely. We have to bounce because I got to go to the new show in 10 minutes.
I got to do a FaceTime for one of the members. Dude.
Maybe as a last question, TJ, can you 2-minute explainer of that 20, 25, 25, 50 strategy?
Sure. So pick a stock.
Tesla.
Okay. So Tesla. So let's say the goal is to let's say you're going to build Tesla, because you're like, fuck it, right? I got 200 grand and I want to build Tesla.
Yeah.
So essentially 25% of 200 grand is $50,000, right?
Right.
It's off the top. That is right. It's 50,000. Sounds right.
It is.
Okay. I'm not as smart as Tevis. Bear with me, guys. So essentially, I'm going to take $50,000, and that's my first bullet. And I'm going to sell some cash secured puts on Tesla, feeling it out over and over until I get put some shares. And then I'm going to get comfortable selling covered calls on that $50,000 worth of Tesla. But then I'm going to bring the other 50,000 into the fold. That's the other 25%. It's my dry powder, right? And I'm kind of going to be hoping for Tesla to dip to make it worth my while. What dip? I'm talking about like a 10, 20% dip, because if I bought shares at 250, I want to buy the next batch at like 200, 210, so that it positions me to average down. So then I'm going to sell cash secured puts, and we're only talking a couple contracts here, right? Because Tesla's an expensive stock. So you'll be selling 2 contracts now and let it play out. Let it play out. Like, get comfortable with the process. And then I'm going to sell, collect premium, sell puts, collect premium, do it over and over. Eventually, you're going to take ownership of the shares. Hopefully, you've already done 3 or 4 or 5 revolutions. Then you're going to sell covered calls on those, and immediately start selling covered calls. Then you're going to initiate the covered strangle strategy by now selling simultaneously cash secured puts with the other 25% of the position. So you're running the cover call campaign, simultaneously running the cash secured put campaign. You got your cover call premium coming in through the door. You got the cash secured put premium coming through the door. You got to be winning one of those trades all the time. You're going to manage whether you're not winning. And then if shit hits the fan and it goes to like 150, like Josh Lewis is saying that it can happen, boom. You're going to go in heavy with 50% of your position, but now you're buying those shares at 150. And that is proper capital management when you're trying to build out a position. You're not going to go hot and heavy at 250. And that's what a lot of people do. And they're like, oh, I lost all this money because Tesla went down. Well, shit, you should manage your bankroll.
Right.
I used to play poker for a living. The most precious thing that I have is bankroll. To me, this is no different. So if you have 200K, dude, work with 50. See how that's playing out on Tesla Avenue. If that shit's not really, you're not liking it, well, maybe you want to go down on Amazon Avenue, so to speak, right? I always add street names to these. They're like condos in my mind, or houses. So if I don't like that, well, let me see what the hell's going on Meta Avenue. You know what I mean? And then you try out other stocks that maybe you're like, hey, I'm more comfortable over here, or I'm going to just go back to SoFi lane because it's been tried and true. You're going to do that. You're going to fuck around with the Bitcoin miner. You could do that. If you're just cash grabbing for premiums, it's at a crazy level. You could do that too. But just keep in mind, if you get caught, like let's say you sell Riot puts at 7, you really want to own them, bro. Just you sell puts at 7, you just turn around and sell cover calls at 7. Get the hell out of there. The premium was good going in and coming out, but don't get into something long term if it was just a trade you got caught on. And I think that's where people screw up a lot, is they turn these bad trades into investments and convince themselves that they're bullish on the stock. I've gotten caught cash grabbing, dude. Call it what it is. You know what I mean? Like, dude, NEO is just a trade. It just happens to be a 3 to 4 year trade, but it's not an investment. They have to like literally say, hey, we're about to be profitable, and then I'll consider it for an investment. It's still going to be a Chinese stock last time I checked. Right. So I'm like, I saw an opportunity to make a lot of money there, but I'm not kidding myself. It's not Tesla.
I mean, I think that's a good place to end it off. TJ, really thank you for your time. This has been, like I said, I took a lot of notes, and I'm sure that once my broker actually allows it, I download the new version of the app, I'm going to be like, okay, here's what I'm looking at. Let's walk it through. Let me add it to a spreadsheet, and let me start studying this stuff on my own so that I can adopt this strategy. Everybody in the chat, thank you so much for watching. Take 5 minutes, go grab a coffee, grab some water, bathroom break, whatever, and then come right back. We will be doing the HIMS weekly at 6 p.m. It will have a different link than this link, so make sure to watch that. TJ, thanks again for
appreciate you, brother. Hey, whenever you're ready, come on an episode of Wheelers, and I'll have 3 or 4 guys that can help you out, and then we'll come on your channel also.
Dude, absolutely. I'd love that. Thanks for watching.
Take care. Much love.
See ya.